Well, hi there. So in this video, we're going to be learning about the one tool that actually is used in an ample reserves framework for monetary policy. So let's get started. Okay, so the first part is actually just a review from lecture one, right? This is just lecture one. And it just kind of tells you about monetary policy, the policy rate, the fact that what we're trying to do is change the interest rate in an economy, and that's really what we're trying to do with monetary policy. Now, I told you last time that there are kind of two different worlds that monetary policy lives in. There's a world where banks hold lots of reserves, they have tons and tons of excess reserves, and then there's ones where they have very limited. And the three tools of the limited reserves framework, required reserve ratio, discount rate, and open market operations, just really don't work. When the banks have tons and tons of excess reserves, it can be very difficult for the central bank to push that interest rate up. It's actually some of the problems that they have. Because you think about it, if everybody has tons and tons of excess reserves, then there's no real reason for one bank to borrow from another bank in that overnight lending market. And if the interest rate in that overnight lending market is super low, it can be hard for the central bank to make it go up. The only way that they could do it is by selling huge amounts of bonds. And I mean this in the sense of like trillions of dollars. And that could really throw off the bond market. So basically around the year 2010, 2012, in that era, the Federal Reserve, along with several other central banks, thought about it and they said, we've got to come up with something different. We can't just sell bonds to make the money supply smaller and push the interest rate up. And again, the reason why they made that decision is a little technical, but in short, they would have to sell so many bonds that it would actually really throw off the bond market. And so instead, they developed a slightly different tool. And it's a nice little elegant tool, actually, to deal with this problem. And the problem that they had, again, was really that they couldn't make the interest rate go up. But this will allow them to actually make this policy rate go up and go down as well. And in this world, this ample reserves world, the one tool they have is called administered interest rates. Administered. Be nice if I could spell. Administered rates. And there are two of them. And the two of them are the discount rate, and I'm going to have you kind of draw this right below it. And imagine the discount rate is like here, is a horizontal line. It's not quite horizontal enough. And then you have this policy rate in between the two. And then you have this other rate that's down here called the interest on reserves. Interest rate on reserves. And these are the administered ones, administered rates. And basically, this acts as a maximum, and this acts as a minimum on the policy rate. It's essentially that what the central bank did is they created a price floor and a price ceiling for that policy rate. And the way that it works is this. If they have a discount rate, let me explain how they work as a price ceiling and a price floor, and then how they could change it. The discount rate acts as a ceiling because if this policy rate is banks borrowing from each other, there's no reason why those banks would borrow for anything greater than what they could borrow from the central bank. At the same time, what I started doing, the Fed, right, when I say I, the Fed, what the central bank started to do was started to pay interest on reserves. And so what it means is that if you're a bank that does have reserves, you're not going to lend those to someone else for less than what you'd receive from me. So this is paid by the Fed, and this one's paid to the Fed, is a way to kind of think through that one, right? Paid to the Fed, paid by the Fed. And so if I have reserves, I'm not going to lend them for less than this interest rate. And if I want to borrow them, I'm not going to pay more than that interest rate. And that actually allows this policy rate to basically float in between these two. And if I want basically the policy rate to go up, then I would move both of these two interest rates up. If I want the policy rate to go down, I would just move both of these two interest rates down. I would say, okay, we're going to move both of them down at the same, and I'd keep the range basically the same. And that's essentially what I do, right? I can change the interest rates. So if I want interest to go up, I move them both up. If I want interest to go down, I move them both down. This gives you kind of that explanation right here for why that is the case. But it's a fairly simple and elegant way to basically push that policy rate to where the central bank wants it to go. Later on, we're going to do a little bit more analysis of this. I'll see you next time.